Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everybody, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Meteora Capital founder and CIO Vik Mittal, his second time on the podcast. Meteora Capital is an investment firm specializing in SPAC-related instruments in both public and private companies. On the show, we discuss what has happened in the SPAC market over the past 24 months, Meteora's approach to investing in the SPAC market, a look into Canna-Global Acquisition, CNGL, what he thinks is next for the SPAC market, and more. So with no further ado, here's a SPAC market update with Meteora Capital founder and CIO Vik Mittal. All right, excited to welcome back Vik Mittal, CIO and founder of Meteora Capital, to the show. We last had Vik on the show about 2 years ago, and there's been a lot of things happening in the SPAC market over the past 24 months. A huge sea change, if you will. Now, I'd like to kick things off. If people want to hear more about your background, check out the podcast 2 years ago. Let's rewind to, what's happened in the blank check market over the past 24 months. Can you kind of summarize some of the major events and initiatives there?
Yeah, absolutely. And I think, Julian, you do a great job of keeping the broader market up to date on new issue trends and, views of the product and things of that sort. What we've generally seen from a sponsor perspective, capital formation has been continued dollar shrinkage of the asset class. My guess is 2 years ago it was around $100 billion of free float in the asset class,
right,
among 400 or 500 SPACs potentially at the peak, or post the peak, to a point now where we're below, I think, 200 SPACs and around 10 billion of assets.
Yep.
I think the one part that we didn't fully appreciate is how some sponsors would continue to do these cashless extensions. We actually didn't expect the investor receptivity to be that great,
right,
where you transfer a number of founder shares and you agree to do the extension instead of the cash per share per month extension. And so, that's been a positive, obviously, for the sponsors, where it's cash light, where they use some of their founder shares to keep the option going, so to speak, on getting a deal done. The negative is it's created a lot of inverted capital structure opportunities where there's a small float, it's like 10 million or maybe even smaller floats to 2-3 million shares or $20-30 million floats that just barely meet the NASDAQ eligibility requirements for the global markets. And the sponsor, presumably because they're using shares instead of cash, have less confidence in the fact that they're going to get something done. You've got 5-6 million shares founder share dilution, which is larger than even if the entire trust was retained. And so, the dilution points are quite significant. And so we're seeing a lot of those work their way through the market. And I think in the back half of the year, by and large, we'll be through a lot of the 2021 and 2022 underwritings. And hopefully we'll be in a healthier place in 2025, where there's 50 to 75 vehicles outstanding, hopefully well capitalized, hopefully by and large with experienced sponsors that have the right pedigree, expertise, the right law firms around the table, so that they can affect a higher quality transaction or something that is investable, that can attract institutional investors. As we stand today, there's still very little in the way of institutional long-only investor interest in de-SPAC companies and companies that go public through SPACs that are no longer SPACs. And those investors, very different from the SPAC-oriented investors that have certainty of the put right and things of that sort. But the long-only oriented investor looks at it and says, here's our dilution points and all these other things. Call us 6 months after your deal closes and there's some price discovery because there's a fully baked float, liquid security, things of that sort. And that's when I think you'll start seeing a healthier product. And, it's not too far around the corner. We need to see regular way IPOs pick up. I think getting past this election cycle, reducing some of the geopolitical macro uncertainty would help. A few cuts in interest rate, I think, always help with growth equities when you're discounting future cash flows. And you get into that environment, I think we can start to see a healthier product. And as long as the investor class and base and investors who invest in the risk capital are judicious in who they give money to, and they make sure that they're giving money to sponsors, that have the right pedigree, I think the asset class can have a longer tail. It just may not be a very fat tail, just maybe a long, shallow tail of 50 to 75 SPACs, kind of the way we were from 2016 through 2020.
Yeah, that makes a lot of sense with a more balanced market. Now, you mentioned the prevalence of what we call zombie SPACs, where they've had a heavily redeemed trust account. They're not paying cash upon extension, and this really wacky capital structure, which just sort of further dilutes the market. But as you indicated, those will sort of go away over time. Now, with respect to de-SPAC investors, I think that's somewhat correlated with the market environment, the demand for more growthy type securities. You look at, say, ARK Invest and the type of stuff that they invest in. It's really fallen off pretty hard lately. And I think more so a lack of quality transactions that we saw a number of years ago. For example, like Blue Owl Capital went public by a SPAC, which is, a high quality business that's a very large size. And if we see more of that, and, perhaps we'll see it from, the Churchill Capitals of the world, they still managed to do a sizable deal with good backing behind it. So it's definitely correlated with quality. Now, if you have a SPAC with, $2 million in cash in trust and bringing out cash to the table, and then to be heavily diluted with all these dilutive securities, then that makes it much more difficult. But we are seeing the odd high quality transaction. That Lionsgate deal, that was a good one. And hopefully we do see more of that. Now, with respect to where things are at right now, SPAC IPO issuance has been picking up. We've seen more than 1.6 billion raised across 10 new issues in the past 6 weeks. What do you think about these new SPAC IPOs coming to market? Some of them are these so-called anchor deals, where you have anchor investors taking down some of the risk capital behind the founder shares. What are your thoughts on current SPAC IPO issues? The last couple have broken price.
Right. I think the IPO part breaking price is separate and distinct from the sponsor risk capital piece. Now, that said, the investors were sold kind of like, look, you buy the anchor, you get your IPO allocation, you make a few pennies there, brings down your net cost basis. But in general, I think the market's just simply saying on a pure yield basis, 24 months and a half a warrant is not going to trade at 10, right? There's a little extra juice. It's disappointing in the sense that it prices the warrants at like 12 to 14 cents, I think, is kind of the calculation that people are doing. So it's like really quite a dim view. And you're even seeing like micro filtering between the GP Act one, I believe, that was the first anchor deal of this wave. Erwin Simon and a private equity group traded better initially. He had obviously was, I think, CEO or co-founder of Hain Celestial. And then he had done a SPAC prior with Cantor Fitzgerald and taken Whole Earth Brands or Whole Food, something like that public. I know the ticker's FREE. That was just recently sold to Martin Franklin and a consortium of private equity folks at like $4 or $5 a share, I think. I forget the exact price, but like a relatively okay outcome, all things considered, given where these anchor investors' cost basis is around $1 something. And so, those type of sponsors we like. We saw M3 Brigade file under this anchor model. I think the market's giving, that type of group, Brigade's obviously, a large scale, durable credit manager. I forget on their last vehicle that Mo Medshi did with the Brigade folks. I think they had Cineverse announced, and then they might have ultimately liquidated. When Cineverse, a multi-billion-dollar, real stable company in the telecom IP networking space that I think Carlyle was a sponsor on, and they're bringing another vehicle. And Brigade obviously is in the news today with their Macy's bid, I think, being rejected was the headline. So you put all of these things together, I think those are the right type of sponsors we'd like to see continue come to the market. The ones that have been public company executives, been on the board of public companies, of operating public companies that have a wealth of knowledge and history in private equity and capital markets, the ones that can bring either their own fund capital to the table or things of that sort, becomes a very attractive pairing and partnership. And I think those are the SPACs that will be very successful in this kind of cycle.
Yeah, we are seeing some repeat sponsors, which always instills confidence with investors. And it's notable you mentioned warrant prices, which have just been demolished. I think the last time we spoke a couple of years ago, they're probably down 90%. I looked the other day, the average warrant is like 7 cents. So that model of 24 months, no overfunded trust, and half a warrant, it gets much less appealing the lower that the warrant prices go. That being said, can you tell us about Meteora's approach to investing in the SPAC market?
Yeah, I mean, SPACs are like we're more of an event-driven, structure-oriented fund. So SPACs are something that we've been involved with for 20 years now. And, we selectively we like to align ourselves with the higher quality sponsors on the sponsor side. If they'll have us, if they're open, we aggressively seek out the opportunity to invest alongside the sponsors that we like and think have the pedigree and think we can be accretive to what they're doing, that our knowledge base and understanding of the capital markets process, understanding all the changing rules, regulations. I think we can, price pipes well. We're, delivering term sheets weekly for back-end financings, whether it be these forward contracts or convertible notes or other, post-IPO financings. But, we spend a lot of time as well doing micro-cap financing that has nothing to do with SPACs. And that's ultimately what's been, by and large, the type of companies coming out of SPAC transactions is small micro caps. And, we want to be an investor through, and the SPAC is a nice conduit where you develop a relationship with the operating team, the management team. And, as they continue to grow, hopefully in the public markets or need access to capital, continue to, finance them that way. I think a good example is Kalidi Biotherapeutics. Kalidi was a company that went public through the First Light SPAC, which we had been a meaningful anchor investor in. Unfortunately, the company has, missed a lot of clinical trial dates. I think relative to their budget is spent a lot of money. They've replaced their CFO. In the recent period, they just did a deal with Ladenburg. We led, that strip of the financing. It was like a common plus warrant deal. The warrants had a reset today. And so, we continue to invest along, and as long as the underlying thesis and the view is this company can make it going forward and, hopefully get through its clinical trials in this example, and we have a decent degree of confidence that the results will be positive based on the work we've done, that those are the kind of companies we want to support in the public markets. Or you go to the other end of the spectrum, like a Lionsgate and the studio spin. It's a simple situation. We invested a small amount in the pipe. It's in the S1. We thought the multiple was off by a turn or two. So far we're generally been proven right. We're watching it very closely. We're seeing how the studio business performs. We're seeing how Starz performs. And we'll, continue to invest up and down the cap table, because we also have meaningful exposure to the fixed income side of the ledger and own bonds, loans, things of that sort. And so Lionsgate had been an interesting topical name since they were doing the spin, as it was meaningful assets moving out of the Lionsgate box and into a new box, and then negatively impacting the bonds. And so that's something that's very interesting to us. And I think that's a long way of saying it's, we'll be involved in a SPAC transaction if we think we can generate good risk-adjusted returns for our clients in some fashion.
That makes a lot of sense. Now, I did want to touch on a specific SPAC situation that has generated some excitement and drama. And the SPAC is called Canna-Global Acquisition, ticker symbol CNGL, which really erupted over the past couple of weeks when they announced a very, very interesting transaction. And, to summarize, this fund, this third-party fund, Liquius, came about and was able to buy additional shares, which weren't supposed to be freely tradable until the completion of a business combination. And they attained those, sort of call them future shares, by paying off the underwriters' deferred compensation. And somehow they managed CST to issue shares now, of which they immediately sold into the market. So it created all these new shares, which there's a lot of uncertainty around if they'll have access to the trust account. Will it dilute the trust account until CST came out and effectively guaranteed the trust value? So what exactly happened here? And I would disclose that you guys did file a 13G with approximately 372,000 shares for about 18.9% of Canna-Global Acquisition. So what are your thoughts on this situation?
Yeah, we were reluctantly dragged into this nightmare, as we like to call it, on the Monday. I forget what day it was, but the Monday when the stock traded off from like the 11.25 in trust to like the 10.50 level. And we had bought a block of stock that Monday, but we're watching like the trading across all the pipes and the channels, and big blocks are going through. Like there's only 1.1 or so million shares outstanding. We're one of the largest holders. You know, we know the other large holders. Everyone was wondering what is going on here.
Yeah.
Like, how can you have these 50, 100,000 share blocks?
That was before the 8K got filed.
That's correct. Yeah, when no one had any idea what was going on. Like, or anyone outside of, I don't even think the insiders, except for that investment fund, knew what was going on.
Yeah, so massive volume on a 1.1 million share SPAC. Like more than the entire float.
Exactly. And so, like around like 3:30 on that Monday, I call the general counsel at CST, who we've worked with on other matters, and I say, "Hey, Mike, like, what's going on here? This makes no sense. Like, can you make any like heads or tails of like what's going on? Like, why is there such volume coming given the amount of shares?" And kind of like hearing him typing away, looking at his computer or something, and he's like, "Oh my," and I'm like, "What's going on? What? Oh my! Don't leave me hanging." And so like.
His heart just dropped.
Yeah, his heart just dropped, and he's like, "It appears that there was an accidental issuance of shares." I'm like, "What does that mean?" What are you talking about?
Yeah, there was
like,
there was speculation that somehow they managed to flip their founder shares to be freely tradable or something. Conspiracy theories.
I thought.
Yeah,
that's what I thought. Because if you look at the 10Q, it's got like an allocation of like 862,000 or something. Class A shares that are not subject to redemption, which are like converted founder shares, I guess.
Yeah.
Because it's like a small float, and like so he like leaves me hanging, and I'm like, well, what's going on here? And then the market closes, and like I'm like in full panic mode, like what does this mean? I've never seen anything like this. And so then it's like 4:30, and I haven't heard back from him. I call him back, he doesn't answer. I call his boss, Steve Nelson, who's the chairman of CST. And he's like, "Yeah, Vic, we're working through this." And I'm like, "Working through what?" And he like, basically tells me what happened, like, and so like, I'm like, "Oh crap, we're like restricted now." Like, like, the name of info. I'm like, "Well, okay, how do we undo this like in the next like 12 hours, right?" Like, before the market opened on Tuesday. And then I call our outside counsel at Arnett Fox. They happened to be underwriters counsel on this deal. Just randomly, they were E.F. Hutton's underwriter counsel. And they were actually aware the wheels were in motion on like this. Like, I guess there were emails flying around among all the parties. So then I call David Burrell, president of E.F. Hutton, and Gaurav, who's their co-head of banking. And they, I don't believe, were even aware of this until like then. Yeah. And they were very transparent. They're like, "Yeah, no, we sold our deferred fee and we had nothing to do with this." So it was they sold their deferred underwriting fee, piece of debt. My understanding is the investment fund was able to get this in their negotiation with the sponsor. It was to be converted into this 1.5 million shares. And I guess they were relying on like a exchange 3A9 or something exemption where you can convert debt to equity and you don't need a registration statement, apparently. Beyond my scope of understanding, or I've forgotten now because it's been explained to me a few times by lawyers since then.
Yeah, and what about an insider filing? Like they didn't file like
right? Yeah. All that stuff. Yeah, there's a bazillion questions about like disclosures on issuing that many shares and being 60% of the float then, and like you're allowed to sell without any disclosure. Forget all that. That's in theory for others to figure out, and I'm confident others will figure it out and solve this issue. But in the here and now on that Monday, I'm like, oh my God, like we're like our hands are tied here, we're restricted, we can't do anything. But we can cry bloody murder to everyone under the sun. And so like David and Gaurav were fantastic. They're like, they were clear, like, we didn't do anything wrong, which they didn't, as far as I can tell. And it's a commercial arrangement, and they sold their debt to a third party at the behest of, the sponsor, right? And now we all know that there was the transaction in the pipe that was with apparently a related party, this investing. So, it makes sense that they're doing a deal that the seller, the operating company, wouldn't have a deferred liability and wanted to clean that up, and made a lot of sense from that perspective to like do something like this. The only part is that Articles 9.4 of any SPAC's Articles of Incorporation do not allow for the issuance of shares prior to the closing of the business combination that are freely tradable, part of the eligible float and other things. So anyways, like Monday works it through. The Putnam guys get like the sponsor on the phone and their counsel, Debbie Kills it, Ramon. We had some prior interactions with Jerry, nothing substantive or formal. A nice elderly gentleman. Like I don't think he fully appreciated everything that was happening here, and he was just signing stuff, is my guess. Debbie's also, I think, a very proficient lawyer. I do think some mistakes were made. We all get on the phone with CST, and like I'm just like trying to play quarterback a little bit, like among a lot of very unhappy people. And I'm like, what the heck happened here? And so I guess the bottom line, and it was disclosed in the 8K that came out on that Thursday after the close, that some law firm who we do not know delivered an opinion to CST to issue those shares today that have the same CUSIP, indistinguishable from the SPAC shares. And it seems like they were issued. Apparently 724,000 of the 1.5 million were issued and presumably sold in the market on Monday. Who knows? Maybe Tuesday, maybe Wednesday, maybe Thursday. I don't know. But certainly I know they were sold in the market on Monday. And my understanding is Ramon Law was not aware that this opinion was issued. They did not issue the opinion. That's what their 8K says. That's what I was informed of. And then the part that so these things happen, mistakes happen, whatever. How this is unwound seems simple to me. The money should be returned. That fund sold 724,000 shares, as far as I can tell, at like $10.50. They should return the $8 million to CST. And then there's like a 75-cent delta that somebody's got to make up for this mistake. It clearly violates the Articles of Incorporation of the SPAC. And then that's where things get a little fuzzier in terms of the communication breaks down. And Monday evening into Tuesday morning, everyone goes into their own corner, so to speak. And it becomes a little bit of a everyone's going to risk mitigation mode a little bit.
Yeah.
And why? And so we sent a demand letter. We were able to get the president of NASDAQ's contact info, their general counsel, DTC, these organizations. We had 2 or 3 senior lawyers, like the senior most individuals in the SPAC practice at major law firms, Monday night reach out to their contacts at NASDAQ, because they're dealing with these people all the time on behalf of their corporate clients for decades on end on their NASDAQ listing applications. We informed them, sent them like a little bullet point summary of what we believe occurred. And it was great. Like guys like Doug Elinoff got on the phone with me at like 11 o'clock on Monday, and then at 11 o'clock at night, one of the co-heads along with Stewart, I think, of Elinoff Grossman. And he understood the implications of this. He understood the implications to the integrity of the marketplace. Mitch Nussbaum at Loeb, Jeff Selman at DLA, all these people understood. And, they tried to be helpful where they can, as they're not mandated by anyone. They're not representing any of the parties in any of these matters, to try to just advance the ball. Because my view was okay, let's get the stock halted for the open Tuesday and get DTC and get NASDAQ to instruct DTC to break all trades. And that would be the cleanest way to unwind this thing.
Yeah.
Break all trades for Monday. prevent settlement from occurring because we're now in a T+1 world. And so, through like 5 a.m., I'm just sending emails to everyone under the sun. I'm copying like every partner at Ramon Law and saying, you guys need to like get in front of NASDAQ now. I'm getting these like cease and desist, stop emailing us responses, things like that. And, and was led everyone from the sponsor, the investor group that had done this to CST, to NASDAQ, to DTC. And so, by, like 6 a.m. Tuesday, I really thought the stock was going to get halted.
Right.
And, we opened, but I never got a response from NASDAQ. I did get acknowledgement through third parties that NASDAQ is aware of this. Debbie told me on Tuesday afternoon that like at 2:00, we're going to have like a discussion with NASDAQ and the sponsor, because they're technically the only ones that have an audience with NASDAQ, right? And, we don't have standing per se. It's just like a random investor. It's just hearsay. It's not like we've seen any of the documentation or know anything. And so, they have a hearing with NASDAQ. They tell NASDAQ what happened. And then, I guess it took till Thursday to kind of 8K this and whatever.
Yeah, and the big concern, it really shook the foundation of the SPAC market, because the belief is that trust account is sacrosanct, and then you basically have that foundation shaken such that, oh, hey, there's massive dilution here. They issued $8 million of shares, and the trust account was like, 11 million. So, hey, there goes your net asset value per share, your cash and trust per share to like, I don't know, $5 or $6.
Yeah, yes and no. My opinion is CST guaranteed the trust.
Yes, prior to that happening.
And then no, I'm saying, but like, I don't think they guaranteed the trust just to guarantee the trust and nice people. I think they guaranteed the trust because they should have never transferred these shares.
Yeah.
And so, and I can tell you, like, whenever we get shares in private companies that are now public companies, it's like an ordeal to get the legend removed and everything else, and to get our prime broker even then to sell the shares. So, I think mistakes were made. The sponsor certainly should not have signed. Apparently, they signed some letter, provided it to CST that these shares could be transferred. And I'm extremely confident CST will never make this mistake again.
Yeah.
And so,
that's insane.
Fortunately, it was a relatively smallish mistake in the grand scheme of mistakes that can happen in this area. Certainly, they've got a track record in history, 1,500 plus SPACs and counting, of ensuring that every penny that's owed to public market investors is returned. That's an important part of the SPAC product. The SPAC program is that public market investors should have confidence in the integrity of the cash and trust, and that's what ultimately makes this product work. So we were, very happy to see that the powers that be stepped in some way, understood it. They acted quickly and decisively. And, I think I posted it online. We all owe CST and Steve Nelson a huge debt of gratitude that they very quickly and decisively acted here. They could have easily said, all right, well, let's see how this plays out over the coming months, and let's see, where litigation and other things take us before we do anything, and left investors in limbo.
Mm-hmm.
And so, and I think that's why historically we've always said CST is the right place for a sponsor and investors to look as who's the trustee on these. This event only reinforced my view that CST should have 100% market share in this market.
Yep.
And that is, it's a credit to the business Steve has built, and, his desire to maintain that leading branding versus, running from this a little bit, so to speak, or letting it play itself out before they decided what move they were going to make on the chessboard. But they ultimately went quickly and decisively. And that's why I think, other than the investors that were largely impacted by this, no one even knows about this.
Right.
I spoke to a senior counselor in the SPAC space last week, and he was completely unaware. Completely unaware.
Yes. It's extremely niche, I guess.
No. But as someone in the SPAC space, right? I mean, hadn't heard about it from his colleagues, hadn't seen anything about it. No one's writing a white paper about it and posting it on, their web portal or whatever. No law firm is.
Yeah.
And I think from an investor standpoint, the comfort we've gotten is that this is just really hard to happen again. Not that it couldn't, but there's a lot of fail-safe points that could have prevented this, that I think by and large will prevent this from happening. I think CST obviously being the ultimate gatekeeper is a good thing.
Yep.
Which law firms are working on a transaction. I think unfortunately investors have to look at that, because you want to make sure you have the best, most experienced lawyers who are working on these deals. And so like on some level, you got to look at the league tables. I just think the underwriter's less relevant here. I don't think there's anything E.F. Hutton could have done differently.
Yeah.
It's great they stepped in and they put a real effort forward. Like Monday, like Gaurav was up till 5 a.m. working on this. He didn't sleep either that night, and we were in constant dialogue trying to advance the ball on this with the regulatory agencies. So you put all of that together and you're in a pretty good spot, in my opinion, going forward. And I think it's just another data point of how these SPACs have been tested in different ways. You've had the Ader situation, the 26 Capital.
Yep.
You've had
FXCO.
The the Saga one seems like it's going to work out okay. It's kind of winding its way towards a conclusion, it feels like. I mean, it's annoying that it has to go through these ridiculous court processes on relatively simple documents.
Yeah.
But even in FXCO, I remember clearly, Continental brought the big guns out to Texas and worked on behalf of shareholders and is their role a trustee to make sure that there was a clear and concise understanding of what's supposed to happen with the trust account, and it's not part of a bankruptcy estate that can be transferred to whatever jurisdiction bankruptcy process is in.
Yeah,
we've had some of these ones in Cayman, so where they've which was the one, I think there was one that had a Cayman. It was the FAT projects had a Cayman.
FAT-P.
Oh yeah, they appointed a Cayman something I forget what it's
called.
Like a
liquidator.
Yeah, exactly. The liquidator to overlook that. So it's good. I think it's healthy. The product has withstood a lot of assaults the last couple of years. From all sides, and it's going to come out stronger as the bottom line. It may not be as large. It may not employ as many people. It may not be something that bigger multi-strats and pod shops get involved with, but that's okay. Yeah. It's kind of like the former NYSE president guy, Tom Farley. He was on CNBC around the time he was trying to close his last deal. I think it was a Bitcoin related, or a Circle maybe was the deal in the stablecoin space. And he was on CNBC before, I guess, that deal got terminated. And he's like, look, a year or two from now, no one's even going to talk about SPACs. It's going to go back to being this small, niche-y backwater product. And I think that's exactly where we're headed. And I think it's best for the product. It's one tool in the toolbox. Not every company should be going public. The product, in my opinion, got ahead of itself, where everyone thought they were a venture capitalist and everyone thought they could take a company public during the 2020 to 2021 window. And not every company should be public, right? And there's reasons to be public, and there's a level of financial resolve that you need to have to be public, financial durability. And so as you slim the product down, I think it'll be tremendously beneficial for the SPACs that are there in terms of outcomes and value creation in the public markets over a longer period of time.
Yeah, so time loose ends on CNGL. CST stepped in, guaranteed the trust account, and I assume they'll, probably litigate to get that capital back from the investor. And it's just testament to the SPAC vehicle being tested when various actors try to pierce that trust account, and thus far they have been unsuccessful, and it reaffirms investor confidence in the structure. Now, last question before I let you go here, Vic. What do you think's next for the SPAC market?
Oh, wow. I think it's back to the future a little bit. I've been kind of consistent in that view that we're back to a 2017 to 2019, early 2020 view, where there will be good companies that come out of the product. And it's just a matter of like getting down to a smaller, more manageable product. Because if you think about like during the boom, getting like 5 wall crosses a day to look at pipes for things, and there's no way to like sanely look at a company and like have a view and say, yeah, this is interesting prior to the announcement. And once you're down to like a ecosystem of 50 and like there's 1 or 2 deal announcements per week, so everything's kind of staged out a bit.
Yeah,
it's much, much healthier, where you can really like dig in on something for like a week or 2, and you can give real feedback to the operating company, the sponsor. This is where we care. This is what we think makes sense. And ultimately, like, hopefully they'll be able to build a book around consensus and either recycle the trust account, recycle part of the trust account, or offer the right incentives to like get more investors in. And you saw that in the Lionsgate studio deal. They ended up offering like some bonus shares for investors that stayed in, and they kept, I think it was like 75 million of the 100 some odd million of trust, if memory serves. And you're going to start seeing more of that, where you get an institutional branding, where there's like a dozen institutions that raise their hands and say, hey, we want to own this at this valuation, this price point. If you can make it happen, we'll own it, we'll anchor the deal. And then all the public investors outside of them, once this kind of publicly disclosed, can make their own judgment, but they'll at least have some institutional validation versus having to guess a bit. And I think that's where you get to better outcomes overall.
Yeah, and you've had the dynamic of effectively the baby being thrown out with the bathwater. Meanwhile, you have quality transactions like Sable Offshore, which actually did quite well and was traded very well. And there are those opportunities there, and we just need more of that and less of the CNGL type situations. Hopefully, just with that.
Who knows? Maybe Invest Inc. is a highly
the next Robin Hood. We'll see.
Yeah, exactly. Yeah, I'm not even sure. I saw the press release like late Friday, and haven't had a chance to look at it very closely, but I was looking at it on my phone. But
not a lot of info there.
Who knows?
Sadly.
So I guess we'll all learn more when they file their S4.
Yeah, sounds great. Well, Vic, always a pleasure catching up, and thanks for the chat and mentioning just getting us up to date on the SPAC market and your thoughts on the future. So I appreciate it.
Always a great time, Julian. Look forward to the next one.
All right, take care.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.